Christo wouldn't like the shape that you're creating with that hat.
Yeah, no, he wouldn't. Christo. Okay, sweet.
So we'll be talking about today, Teach.
Pain points in the market, bridge loans, all that fun stuff. I mean, what are you seeing pain points right now?
I mean, that's the biggest one. It has been the biggest one for the last couple years.
Yeah, I feel like it's even more relevant right now, though, because I think you've got people that have been waiting for so long.
Oh, it's true.
And they're like, okay.
Yeah, we're finally starting to see people trying to test the market a little bit more with their properties they're trying to sell, hence why inventory has gone up, and which means we've got more people in situations where they're like, I want to buy, but I can't until I sell this house. And so I'm just stuck.
Yep. And then they come to us because they start shopping, which probably maybe they shouldn't even be shopping this aggressively at this point.
Right.
But nonetheless,
it's
human nature. And a property pops up. They contact us and like, okay, my house has been listed for 90 days. I can't go below X amount of number. Who knows why? And rightfully so. What can I do?
Yeah.
We have bridge loans here, but bridge loans might not always be the best route to go. They've got added fees. There's more hoops to jump through.
Yeah. And everyone has heard of them, you know, and that's why oftentimes, like, we'll typically get the call from the real estate agent, like, hey, you know, they want to be able to buy this house. Of course, they were just casually looking, and the opportunity came up. Do you guys have any bridge loans? So, I mean, everyone's heard of the bridge loan, but we have a different route that we like to take oftentimes because, like you said, the bridge loan is great in theory, but most of the programs, they have too high of fees.
We're talking like it could be tens of thousands of fees added to it.
The process is ridiculous for the most part. I mean, it's not an easy underwrite. And so we have we've almost, like, we should probably patent the idea, honestly.
I know, seriously. There's our retirement plan.
Yeah, and it pairs so well with our expanded program.
Yeah.
And so, I mean, you explain it.
Yeah, well, it's funny. I actually heard this yesterday from another industry professional. We were on like a mastermind call together, and he called it the Two-Home Tango. It's like, it's what we're dealing with right now because of this is so common. Essentially, this is a in-house product that Cross Country offers. Rates in terms are a little bit higher than normal, but not ridiculously higher. And
about a point to a point and a half.
Exactly, which other bridge loans could be even more than that, plus added fees on top of that.
Yeah.
Point being, though, is once this is all said and done, we can refinance you back to a standard loan, which that will be part of the game planning process with the client. But essentially, the biggest pain point for these borrowers is oftentimes they can't qualify for both mortgages. If they feel like they can pull it off, sometimes they can't even qualify nonetheless. So what we do is this program allows us to exclude the payment from their debt to income ratio, meaning when we pull out their credit report and it shows their mortgage payment, from their vacating residence, we don't have to include that.
And it's any debt that's tied to the vacating residence.
Exactly. So if they've got other debt, HELOCs, whatever, we can exclude that.
Positions.
Then what we might advise them to do is then just buy the other house, and which seems pretty easy. The pitfalls that come there, maybe they don't have liquidity to put down a large enough down payment to qualify because maybe they've lived in the vacating residence for 10, 20 years. Well, our solution to that is with a HELOC.
Yep.
Get a HELOC on the vacating residence, which we can help with that. And if time is a crunch, we've got a HELOC that can fund in like 5 days.
Yeah, it's almost functions just like a hard money loan, and the fees are relatively cheap. I think a point or two of the loan amount.
They're definitely cheaper than the alternative,
right?
Going the bridge, than going with a normal bridge loan.
Yeah, because from what I've seen, market standard with the bridge loan is generally you're using the bridge loan to buy the whole house. So it's not the 2-loan thing that we're trying to accomplish here, and it's anywhere from 3 to 4% of the purchase price and fees.
Yeah.
Well, that expanded program that you were just talking about, paired with this HELOC, we can structure it to where it's, you're not buying down the interest rate. It's a pretty low cost mortgage, and it's 30-year fixed, even though the rate is 1% to 1.5% higher.
Yeah.
we could structure that very low, get seller credits to cover the cost for that. Really, the only thing that they'd be out of pocket for is if they needed the HELOC to cover the funds for the down payment, and paying the origination fee for that. But you get
and I even game plan. I mean, because we can't put like unrealistic expectations with the borrowers that as soon as they do this, their house is going to sell, and it's just going to be all rainbows and butterflies. Which, I mean, let's face it, probably just with how the world works, sometimes that is what happens. As soon as you go through all the hoops to do it, it will sell the next week.
Yeah.
But we've got a game plan for a little bit of risk mitigation here.
Oh, yeah.
And so oftentimes I'll even game plan with the borrowers. Okay, maybe now with a HELOC's cool because you're taking out a line of credit. You don't have to use the line. But I always say, let's max this out. That way, heaven forbid, it does take longer. Let's say it takes 4, 5, 6 months longer to sell this property. You've got the liquid asset there that you can borrow from to make payments.
In the event it
doesn't. Longer. Yes, and then when it does sell, you're essentially just paying yourself back.
Yeah, and this sounds super risky, but let's frame it a little bit more because the home equity line has limitations. You can only borrow up to 80% of the value of your house. So you're still going to have room for net proceeds when the property does actually sell. So you're not over leveraging the current house that you're in.
Exactly.
Which some people might point out, like, this is super risky. This is stuff that led to 08. No, it's not.
Yeah.
There's way more parameters put into place.
Yeah, we can think TRID for that.
Yeah, exactly. So that's going to help with that situation, overcoming that risk, even if we advise them to take all the way up to 80%. But then the other thing is, too, with this program that allows them to exclude any vacating residence debt, they have to have 12 to 24 months of reserves, meaning whatever the payment is, times that by 12 to 24 months, they have to have that accessible, whether it's from the HELOC or in cash or retirement. They have to show that they'd be able to make the payment for anywhere from a year to 2 years.
Right.
So they're not getting set up for failure here.
No.
But the nice thing is the best case, when it's executed well, make 6 payments on this mortgage. Ideally, you're selling the house within that time frame. Then we can just refinance back into a traditional Fannie Mae, Freddie Mac loan and lower the interest rate. Even if rates don't change, even if rates stayed the same, they're going to save 1% to 1.5% on a refi. So the plan is just
it's a no-brainer at that point.
Yeah, I mean, there's so many backstops that are created because of the underwriting guidelines that don't allow the client to be put in a bad situation, which is probably where people's head go when we talk about this program. It's like, that sounds super risky. I'm taking on 2 mortgage payments and then potentially a home equity line, which has a payment. That just sounds like over leverage, like we're going to be foreclosing.
For sure. And that's the kind of like what we talk to people about this. We just like to take the emotion out because now you don't have to, when a property pops up that someone wants to buy, it turns into a fire sale. They just want to get rid of the vacating residence and they could be leaving proceeds on the table. Now they're acting more, what's the word? Technical. They're strategic. There we go. Strategic. Everyone, they want me to change my Instagram handle to strategic and just a capital T and a capital J. We'll see if that makes it. Anyway, if that makes it on there. But now you take all the emotions out of it. We can go more strategic.
Yep.
And
does your home and auto insurance seem to go up every year without fail? Mine did too. I thought this was just the way the insurance industry worked until I found my friend Alan Johnson with American Family Insurance. After more than 15 years with the same insurance agent, he saved me over $3,000 per year when I switched. I refer all my family, friends, and clients to him, and their experience is similar. Great rates and a great experience. Call Alan for a free quote today at 801-708-2962.
You can keep the property for multiple months on end. If there's a number that you know you can eventually get, you just have to wait for that right buyer.
Right.
There you go. And then as an agent, you can set these proper expectations with the buyer that this doesn't have to be a fire sale. And now next thing you know, you're going to have a better relationship with your client because they're not going to be asking you, why isn't this selling? And you don't have to advise, well, let's slash the price by
slash price 5% every week until it sells.
Exactly. And which never creates happy clients and happy agents.
Yeah.
So
yeah, I agree with that. Because honestly, when you're selling, sometimes it is a little bit of a timing thing. I feel like there's busier seasons of the year. And if you're stuck on the market going through winter and you need to move out of the house to buy, you're going to be forced to slash that price and take massive loss. Yeah. But if you could float yourself back into spring where there's more transactions going on, more buyers in the market, and maybe you can do with this home equity line, maybe you can do a couple improvements to the house and up the curb appeal. Like you have more time, which ultimately will help you either offset the costs of bridging the multiple payments, or maybe even increase your net proceeds.
Exactly.
Depending on
or even
how
just
it plays out.
I love what you said, like even like the curb appeal. Can you get more traffic in the house with the upgrades you're doing? All of that little stuff, that
takes
counts.
the time constraints, which oftentimes are a big killer to proceeds. You don't have the time to make the money to make the repairs or do the renovations and give the property the lip gloss, then I mean you're going to be forced to take less than what you wanted to get. Exactly.
Well, and it really turns this market into your advantage as a buyer and a seller, because right now this is a buyer's market. I mean, we're in a transitional market. There's still going to be the properties where they fly off the shelves. It happens every so often.
Right.
But now you actually have the ball in your court. You can buy with the best terms, get all the concessions, because let's face it, these programs are a little bit higher. The one we're talking about, the alternative, it's a little bit higher in fees. Not as much as a straight up bridge loan, but if we've got seller concessions, that can offset that. And you can walk in probably with equity in the house you're buying.
Yep.
And then flip the script when you're selling. This gives you that versatility where you don't have to accept a lowball offer. It turns this into a win-win for the client.
Well, and you could, like that time frame to hit back on that, like you could then create your property or make your property be one of those that is flying off the shelves by the time you're done doing the work and marketing it right and pouring the time it takes to sell the house. You could be the multiple offer house.
And you don't have to be that client that is, I've got to wait for my house to sell before I can start searching.
Yeah.
Because if there's a property that pops up, now is the perfect time to pounce on it.
Which is another detail. I mean, I have to double check this, so don't hold this to heart. But you don't have to be listed for this particular program to qualify. You can have a listing agreement. I believe you just need to be listed within 6 months of the purchase.
Yeah, that's a detail.
Settlement.
I can't remember that either because it did change. We don't like to memorize guidelines because whenever we memorize, they change them. Yes, this burned us in the past.
Right.
But because in the past they were like, you have to sign a letter of intent stating you intend to list the property within 90 days. There's been a couple of different variations of it.
Yeah. So whether it's 90 days, let's say it's 3 to 6 months, that's now time that you have to heavily pour into the listing while still being in the new house, move out of it completely.
Yeah.
Maybe stage it now. Now you have the option to stage it because your stuff is out of there.
Right. It's just going to show way better.
Completely up the curb appeal within the 90 days before actually listing it.
Yeah.
Which could make or break how quick that sells.
For sure. And this is something that we work with our agents all the time. So if you're an agent out there and you're like, my lender doesn't really talk about this or through this with me, let us know your situation. And this is kind of the stuff that jazzes us up. We're excited about this time and time again. And if you're a client, this is something you're thinking about selling but are nervous because of this, let us know, because the first step is really just talking with us and figuring this out.
Yeah, because it's really stressful to sell and buy, even in COVID.
Oh yeah, any market. It's never fun to move. I hate moving.
But you would struggle finding the house you wanted to buy and getting the offer accepted. So like, if you have an option where you can get into the new house and all you have to do is really commit to 6 payments before you can refinance and
it's funny you say. I think people romanticize the COVID market a little bit. They forget the pain points that did exist.
Yeah,
there are a lot of people that ended up in the house they didn't really want to be in.
Right, because they're like, well, we're under contract already. I've got to be out of the house at this date. Like, we just got to put in an offer on whatever we think is okay right now. Because rates are really low, so you can't pass up on it.
Exactly. You just had to take advantage of the low rates then, and right now you need to take advantage of what
There's
this market.
Points in every market. I think this really could solve, like in that market. I think it can solve the pain point in any market, having these types of options.
For sure. So awesome, guys. Well, we hope this helped. If you guys have any questions about that, hit us up. You know where to reach us. And then if you could, please remember to like, subscribe, smash the like button, whatever the people do nowadays. We appreciate you guys.
Thank you for tuning in. For more industry insights, follow us on all platforms at Loans Elevated.
And to get in touch with our team, call or text 801-713-4000 or visit loanselevated.com.